I want to start with a receipt, not a prediction. If OPEC Plus was a cartel in the classic sense, the rule is simple. Everybody sacrifices a little volume so everybody gets a higher price. But what happens when the sacrifice is optional, the cheating is routine, and the punishment is politically expensive? That's when a cartel doesn't break with a dramatic announcement. It breaks the way trust breaks. Quietly, with paperwork, with updated plans, with compensation cuts, with members nodding in public and freelancing in private. That dynamic is the seed of a price war the market usually prices too late. I'm recording this right now, Dubai time. Comment where you're watching from. I actually read those to see how global the FinTalk OG audience is. And if you want the next video in this series, subscribe and comment FinTalk OG so I can pin you when it drops. Standard disclaimer. This is education and entertainment, not financial advice. I'm not your advisor. I don't know your risk profile, and commodities can humble anybody. I may mention instruments and market mechanics to explain what's happening, not to tell you what to buy. Do your own research. Now let's talk about the price war nobody is pricing in. Because most people don't even know what to watch. When you hear OPEC Plus is pausing output increases, your brain hears stability, coordination, adults in the room. But that headline can coexist with something much uglier. Producers exceeding targets, then filing compensation plans that are basically IOUs to the cartel. If you're seeing those IOUs grow and you're seeing repeated talk of updated plans, it's not a sign of strength. It's a sign the rules are getting harder to enforce. Let me translate compensation cuts into real life. Imagine 10 people agree to split the bill evenly. 2 people quietly order extra, but they still want the group discount. Later, the group says, okay, next dinner you 2 pay extra to make it fair. That extra payment is the compensation cut. But here's the issue. If the same people keep ordering extra, the debt never gets paid down. The honest people are subsidizing the cheaters. And eventually the honest people do one of 2 things. They either stop being honest or they force a reset. That reset is the beginning of a price war. Because a price war isn't always we're flooding the market tomorrow. The modern version is a discipline event. A move designed to punish noncompliance, regain control, and remind the group who can survive low prices longer than everyone else. That's why these compensation headlines matter so much. They're the early tremors. Now add the part retail audiences almost never hear. Oil is not just a commodity. It's a macro input. Oil is inflation psychology. Oil is rates. Oil is credit spreads. Oil is a sector rotation button for equity markets. So when OPEC Plus cohesion weakens, it's not just oil might go down. It's the distribution of outcomes getting wider. It's whipsaw risk. It's volatility. And volatility is what breaks portfolios that are kind of right but positioned like they're guaranteed stability. Here's what makes this moment especially dangerous. The demand side is not giving you a huge cushion. There are major forecasts suggesting demand is still growing but not exploding, while supply dynamics can create surplus risk depending on the scenario. When demand growth is modest, even small cheating barrels can become price-setting barrels. That's when the cartel needs more discipline to keep price high. And that's exactly when discipline becomes more politically costly. That's the trap. And it's the trap most commentary misses. People keep asking, will OPEC Plus cut or not? That's a spectator question. The investor question is, has cheating become the dominant strategy? Because once cheating becomes the dominant strategy, the cartel has 3 choices, and none of them are comfortable. Choice 1, tolerate cheating and slowly lose control. Price becomes harder to manage, credibility erodes, and every meeting becomes a volatility event. Choice 2, cut even more to offset cheating. That means the compliant members carry even more pain, which eventually breaks the coalition anyway. Choice 3. Force discipline. And the most effective discipline is a period of lower prices that punishes the weakest hands first. That third choice is what the market underprices, because it sounds irrational until you remember the cartel's real objective isn't maximize today's price. It's maximize control of tomorrow's price. Now here's the finance lie detector that tells you whether the market believes the cartel, the futures curve. Spot price is the headline. The curve is the confession. If the curve is in backwardation, near-term prices higher than future prices, that often signals tight physical conditions. If the curve shifts toward contango, future prices higher than spot, that often signals storage value and comfort, a market that expects supply to be more than enough. A cartel can talk up the spot price with headlines. It's much harder to bully the entire curve if traders believe a surplus is coming or credibility is fading. So if you're watching OPEC Plus headlines, but you're not watching the curve structure, you're basically watching the trailer instead of the movie. And when the curve stops responding to bullish policy language, that's the market saying, I don't believe you. Now let's talk about the paper oil layer, because this is where the move can get violent. When a market gets comfortable with a smooth story, OPEC Plus will manage price, capital piles in. Futures, options, structured products, hedges, macro funds, CTA models, risk parity correlations, all of it starts leaning on the assumption that policy equals stability. And then, when the underlying regime changes, when cohesion weakens, prices don't just drift, they gap. Because you're not just repricing barrels, you're repricing positioning. One public signal for how crowded the paper side can become is open interest. ICE has published commentary about record open interest across futures and options markets, including oil. That doesn't automatically mean crash. But it does mean there's a lot of money tied to expectations, and a lot of that money is sensitive to volatility. Now zoom out and remember what everyone has in their muscle memory, the last time the discipline question got answered the hard way. The 2020 Saudi-Russia price war is the ghost story that still lives in every oil trader's head. I'm not saying the world is the same, and I'm not saying the catalysts are identical. I'm saying the mechanism is memorable. When cohesion breaks, market share fights get ugly, and price becomes the weapon. That memory is why oil volatility can spike on boring OPEC Plus language. Because the tail risk isn't oil down 2%. The tail risk is oil down a lot, fast, and then the second-order effects hit, energy credit spreads widen, high yield gets nervous, M currencies wobble, inflation expectations swing, rate cuts get repriced, and equities re-rotate. If you want a simple panic meter for this, watch implied volatility in oil. SIBO has discussed cross-asset volatility spikes tied to oil moves and geopolitical risk. That matters because it shows you how quickly oil stress turns into broad market stress. If implied volatility stays elevated even when price looks calm for a day, that's the market paying for protection, meaning fear hasn't left the building. So here's the thesis in one sentence: the market is pricing managed stability, while the internal mechanics are drifting toward discipline or fragmentation. And that mismatch is where the price war risk lives. Now let me make this extremely practical, because this channel is not for oil trivia. This is for money. If OPEC Plus cohesion weakens and crude starts sliding, the trade is not just crude. Upstream producers can get hit because their revenue is the commodity. Refiners can behave differently depending on product demand and margins. Sometimes refiners can even do okay in a falling crude environment if margins are strong, and there has been reporting about refining profitability remaining firm in certain periods. Tankers can become a chaos trade because routes, risk premiums, and freight can move on geopolitical friction even if crude price whipsaws. Airlines can benefit from cheaper fuel, unless the reason fuel is cheaper is recession fear that crushes travel demand. And credit markets are the sleeper. Energy high-yield stress can tighten financial conditions more broadly. Now, I want to give you the three scenarios the market is juggling because you'll recognize which one the crowd underweights. Scenario A, managed unity. OPEC Plus maintains the pause, compliance improves, compensation cuts actually happen, the curve stays supportive, price stays relatively controlled. This is the comforting story. Scenario B, soft cheating. Members keep drifting above target, but not enough to fully break the market. Price chops. Volatility stays elevated. The curve gets conflicted. Every meeting becomes a risk event. Scenario C, discipline event, the price war path. Leadership decides the only way to restore credibility is to force the issue, even if it means lower prices for a period to punish noncompliance and reset expectations. Most people ignore Scenario C because it sounds irrational. But if your goal is to preserve long-term control, a short period of pain can be rational. Cartels are not charities. They're control systems. So what should you actually watch, like a trader, not like a fan? Watch the size and frequency of compensation headlines. If plans keep getting updated and the numbers keep swelling, it's a signal the group is struggling with enforcement. Watch the language around voluntary cuts. Voluntary means reversible. Reversible means political. Political means fragile. Watch the timing of planned increases against demand and inventory outlooks. If major outlooks keep talking about inventory builds or surplus risk scenarios, extra barrels matter more. Watch the curve reaction. If spot pumps on headlines but the curve refuses to price sustained tightness, belief is fading. Watch volatility. If implied vol stays elevated, the market is telling you I don't trust stability. And for anybody who wants a quick visual explainer reference point for how mainstream outlets frame OPEC Plus decisions and market reactions, there are short clips you can look up and mirror for pacing and B-roll style, like Reuters' short segments on output decisions. Now here's the clean metaphor you can steal for your own brain. OPEC Plus is like a classroom where the teacher says, "Everyone put your phones away." Half the class actually does it. The other half hides the phone under the desk. The teacher pretends not to see it because the room is calmer that way. But eventually, the students who followed the rule realize they're the only ones suffering. At that point, the teacher either enforces the rule hard or admits the rule is fake. A price war is the enforce it hard moment. So my closing point is simple. Don't get hypnotized by the headline that says pause. Don't get hypnotized by the idea that OPEC Plus equals stability. The real story is credibility, enforcement, and incentives. If cheating becomes normal, discipline becomes a weapon, and the market often doesn't price that weapon until it's already swinging